When you want to be successful in trading, and I mean long-term successful, then there are certain things that you need to consider and adhere to. Especially for beginners, it is difficult to identify the core points that are important when you do trading because the topic is very complex. I therefore have decided to formulate 11 golden rules of trading that I myself adhere to when I do trading. And I also decided to put this section rather towards the beginning of the entire course, even though many of these aspects that are mentioned here will be discussed in more detail throughout the course, but I still decided to put them into the rather into the first sort of section of this course because it prepares you for what is to come. And as I said, these will be further discussed in more detail, but because repetition is so important when learning, I decided to already give you an overview. So let us take a look at the 11 golden rules that I have identified that I think are important to be adhered to. So the first rule is that always trade with the trend. When we trade, we want to have an edge, which means we want to have an advantage. Therefore, always trade with the trend in the market. In other videos in this course, I will discuss what a trend actually is, how a trend can be recognized, but it is very important to adhere to the trend because you're not making the market, you're not making the trend direction. We as retail traders, we can only go with the trend. When markets start moving, what we can do is to identify the points in the charts that can give us a competitive advantage, an edge, and then we can hop on board of the ship, which is going with the trend. Yeah. So if you do this, you have the probabilities on your side. So the second one is to plan the trade and to trade the plan. When you go on holiday, for example, you should ideally make a plan before you leave. And exactly this is what you need when you want to trade. Put up a plan and then just adhere to it. It is easier said than done, of course, but it is important as you don't get lost on the way. If you trade according to your plan, you will reduce emotions and you will be more successful. The trading psychology aspect is part of another video of the course, but as I said, before you do something or anything in life, which is a little bit new here, or which is something that you are going to do, you should ideally develop a plan. You should have at least a roadmap in mind. You should have an idea of what you are doing. So the same with trading, you need to have a plan and then just stick to it. So the next one is to keep it simple. Many beginners put too many indicators or oscillators onto the chart. Various TA platforms that you can use allow you to add just all sorts of indicators. There are hundreds or thousands of different indicators. The problem is that an indicator is nothing else than a calculation based on the price. And you should not add too many indicators to the charts because this will not really give you a lot of additional benefits. The problem is that many indicators do not really point into one clear direction. The higher the number of indicators is on your chart, the less likely it is that they actually give you a clear signal because they sometimes also contradict each other. So my view is to keep it simple. Do not change your strategy is the next golden rule. So the so-called system hopping or the change of strategy is not really recommended. At least you should not change it too often. Of course, you need to get an idea of how a certain strategy works. You need to try it. If it doesn't work, go to the next one. But what you need to understand, there are various hundreds, thousands, countless various trading systems on the market and also trading strategies that you can actually follow. However, every system produces losing trades as well. There is no system where you can only produce winning trades. It is just part of the game. And if you try a new system and you then start to have a few losses, you should not immediately reject it and go to the next strategy. Do not permanently change your strategy. Give it a bit of time, give it a chance. And like every business, you have costs when trading. Some of these costs are produced by losing trades. It's not only the trading fees, no, you have losing trades as well. And they are just part of the game. They are just part of the business. So the next one is that before you actually start trading, you should start with a demo account. We will get to that also in later videos, but many exchanges offer such a demo account. It's a bit like when you do a driving lesson, and you shouldn't, or when you go to driving school, you shouldn't just start to drive without knowing how to do it. And the same way, you shouldn't just start to trade and risk your own hard-earned money without really knowing what you do. And to try out new strategies, to try out new things, it is worth to start with a demo account. And even experienced traders sometimes use a demo account to just try a new strategy. So by using such a demo account, you can get familiar with the different order types. There are, by the way, 4 types of orders, and you can get familiar with different strategies and how also to use your trading platform. So the next one is to try only one single trade setup. Especially when you're starting out, it's important not to try too many different trade setups. So later we are going to discuss in more detail what actually a trade setup is, but let me give you a brief explanation now. So a trade setup is a certain situation in the chart analysis, in the technical analysis, that gives you a signal to enter a trade. It is that moment that happens when you can have an advantage. So one example is, for example, a channel or a pattern out of which the price, for example, breaks out. Only get familiar with just one setup. Yeah, you can obviously trade that. For example, you can trade the breakout, you can trade the pullback after the breakout, the retest, This is one possible trade setup. And again, there are countless setups, thousands of them, and you need to start somewhere. So stick with one of them first, get familiar with it, refine your strategy before you can actually go to the next one and understand if another one might be working better for you. So, and again, in later videos, I talk a little bit more about what actually a trade setup is, and also we talk about the different types of setups. So the next one is do not hunt the price. One characteristic of a good trader is that good traders do not run behind prices. They are not hunting the prices. So let us say you observe a chart and suddenly, you observe a certain situation and suddenly the price is actually breaking out. And it is, for example, done this without retesting. It is going up too fast. You didn't anticipate that. And your trade setup included a retest of a support level. So basically you missed out because you were waiting for that retest while the price is actually going up. So what good traders do, they would not run behind the price. So do not make the same mistake, and do not make the mistake that many people make and hunt the price and run behind the price and try to hop onto the train, even though it might be too late. Because, let the price come back to you. The price will always come back. And do it like a hunter. You wait for the price to come back to you. You know which price you wait for, so you know your strategy and you know your trade setup. This is then when you go in, when the situation is right. You had something in mind when you thought about that trade setup, so do not run behind the price. This is also related to FOMO, so the fear of missing out that many people have, especially beginners who don't know that prices usually after a breakout come back anyway. It might take a bit of time and their patience comes in, but yeah, do it like a hunter. A hunter would also wait, for example, for the deer, and would not run behind it. They just wait for it. And that is what you need to do as a trader as well. And therefore, I also recommend to use limit orders and only to use very rarely market orders. But we are going to talk about that in a later phase of the course. So the next one is to always know your risk. You need to understand how much money are you going to risk with each trade. Make sure that you know about your risk management. Risk management is one of the most important aspects of trading that many people miss out on. They don't do it. They don't know how to do it. And therefore they oftentimes burn their fingers. They lose too much money and then they are done with trading. So make sure that you know what you risk in the worst case. I recommend never to risk more than 2 to 3% of your entire capital. Never risk more than, for example, 20 to 30 US dollars if you have $1,000 in your account per trade. Always only trade chance risk ratios of at least 2 to 1. So if you trade, then the potential gain you can see should at least be twice as high as the potential loss where you set the stop loss. we will talk more about what the chance risk ratio is, how you calculate it, and how to set stop losses later. But just for now, remember or keep in mind that a good and a profitable trader is also a good risk manager. So the next rule is to let winners run and don't hold on to losers. A reaction of many beginners is that if a trade runs into profit, and honestly, I made the mistake myself in the past, then many traders tend to close the trade too early because they are afraid the trade could go back into the loss. So people want to close the trade to make as many profitable trades as possible. However, this oftentimes doesn't work out. So oftentimes they close the trades too early, and in terms of losing trades, they hold on to the losing trades. So they don't basically make enough profit, but they make too much loss. So you need to have the mental strength as a trader to let trades run if they are in profit. The trend is your friend. Yeah, you can ride the trend as long as it is there. We are working with the trend. And if you recognize the trend, then there are good opportunities that the trend also continues. You know, the probability is on your side. And then again, traders often hold on to losing trades. They do not have the mental strength to accept this and to close a trade if it is at a loss. So of course it hurts when you make a loss, but it's part of the game, it's part of trading, and you need to understand, and then it is easier to accept it. You know, a lot of professional traders, of course, or every professional trader makes losing trades as well. But as long as you are making more profitable trades than losing trades, and very importantly, you let them run when they are in profit, then you should be good. So part of the game is to accept losers as losers. Hold onto your plan, make a plan, hold on to it, and close a trade only via stop loss. You can also use a trailing stop loss, and we're going to talk about that in later videos, just to make sure that winning trades are getting protected. But again, we are talking about some of these strategies in later videos. So the next rule is to have an emergency plan. You should have an emergency plan, and I mean that, for example, if the laptop or the PC that you normally use for trading, if that breaks down, then you need to have a second one immediately. If you really take trading seriously, this is part of risk management, because you need to know that this is your tool. How can you work without a proper tool? If your tool breaks down and your income is dependent on it, then, and it will be at risk, then you need to have that emergency plan. Ideally, you have a second laptop or a second PC already set up with your trading software, with your login data and everything, because you know, if the first one is broken down, you might not have the time to set up a new one. Even though you say, okay, I've got my smartphone, but do you really think you can do, you know, sort of professional trading from a smartphone? It is extremely hard. And even as a part-time trader, you want to have a good overview of your trades, yeah? So trading only with a smartphone is not recommended. The next one is to have a trading journal. So to trade profitably, you should have a trading journal and to document your trades. Yes, it takes some time, but it is definitely worth it also for the learning experience. Later in the course, I will show you the different possibilities, how you can document your trades. This helps you to analyze your trades, and you can run statistical methods to analyze. So it doesn't mean you need to have a piece of paper where you write it down. No, you can use Excel sheets. There is also free software in the internet where you can do it, and that allows you to test and to calculate or to analyze really your trades automatically. So we are going to talk about that later in the course as well. And it will always give you the possibility to go back to previous trades and to check if you actually adhered to the rules. And it will motivate as well, especially if you analyze your trades, and then over time you will see that you're actually getting better and better. Okay, so with this I showed you 11 very important rules about trading. These are really the key ones. Of course, there are always more guidelines, more things to be aware of, but these, for me personally, these are the rules that should never be broken.